The US dollar has taken a sharp turn in recent weeks, and markets are starting to take notice. After years of relative stability, the US dollar is now down over 11% this year alone, and that might not sound like much in the world of currencies, but in macroeconomic terms, it is seismic. What's even more concerning is how this drop is happening and the fact that at its very core lies the global loss of confidence in Washington. For years, the US has run extremely loose fiscal policy, trillions in deficit spending, massive debt accumulations, and very little political appetite, if any at all, to be frank, for serious fiscal reforms. At the same time, trade tensions and tariff uncertainty, particularly under the Trump administration, have added investor unease. While many brushed off concerns about the dollar's reserve currency status in the past, the recent developments are causing even the optimists to take a step back. It is not that the dollar is about to lose its dominance overnight. It's not going to happen overnight. Becoming the world's reserve currency took decades, and this is something that I will cover in greater detail in one of my upcoming videos here on my channel. But it is not something that will unravel in the matter of months, in the matter of weeks, but there are growing signs that a risk premium is now being built into the dollar. In simple terms, it means that investors are beginning to demand more and more compensation for holding U.S. assets, and that shift in sentiment can snowball very, very quickly. Let's take a closer look at what's driving this change. Earlier in the year, some of the dollar's weakness was attributed to external factors. For example, in March, Germany surprised markets with a large fiscal stimulus package. That news alone caused the dollar to drop 4% on a trade-weighted basis, and when you factor that in, the dollar's performance since the US election didn't really look too bad, basically flat. But something has shifted. In recent months, the dollar has fallen sharply against the G10 peers, even as US rate differentials have widened. In plain language, the gap between US and foreign interest rates has grown, which is normally a reason to buy the dollar, not sell it. The fact that the dollar is still falling suggests something is fundamentally broken in the usual relationship between rates and currency strength. This is not just market noise. It is reminiscent of the 2022 UK scenario where investor confidence cracked in the face of unchecked government spending.